Okay, good evening. Tonight is Tuesday, November 20th, and I'm going to be talking about mergers and acquisitions for this evening. This is what I do during the day, so I got quite a bit of background in this area. Reminder, the timesheet for Go Help a Real Business is due in class next week. Next week is the last class of the term. The final exam, Saturday, December 15, 2 o'clock. They haven't announced a location yet, but at least now you know the day and the time. So all chapters from the course are on the exam, including next week's lecture, which is on valuation, which is a bit of a gap in just in general in the business that you learn here. And so I decided, since that's what I do Monday to Friday, that I came up with my own material for one class. And it is going to be, I do have a couple of multiple choice questions and a written question on the final about it. It's going to be 60% multiple choice, so 30 multiple choice question worth 2 marks each, and 40% of written problems, probably somewhere in the order of 5 or 6 maybe written problems. I haven't written the exam yet, but that's what the plan is. Formulas are going to be given to you in a formula sheet on the last page of the final exam, so it's convenient. You can pop it out, just like it was, just the exact same setup as you saw it on the midterm. The suggested exercises, like I said before, me and the TA, we put in a lot of effort into making those, so hopefully you're using them, and that's definitely one of the best ways to study. You know, this is a course that has a lot of different math examples and so on, so it's important that you get, it's more about practice and, you know, knowing how to do all the different types of problems than it is about reading a pile of chapters and memorizing a bunch of words. So looking at the examples that I have in the slides, looking at the more examples that I have in each slides, and the suggested exercises at the end of each chapter in the textbook, that's really where you should put in a lot of effort to get ready for the final exam. And also, well, you already know this, but the PDF slides that I use and the notes, which are what I write on the blackboard, both of those things are available on WebCT. Any questions at all before I continue? Yep. Oh yeah, thanks for reminding. Yeah, I'll put one up. Yeah, I'll put and people have asked for one, just the original one and the one with solutions. So I put up 2 versions, like one this is just the exam, and then one which has the solutions in it. Yeah. I did that for the midterm, right? So it's going to be this. Yeah, I'll just put the, once I have the final exam done, I'll just copy that page onto WebCT. Yeah.
And I don't know if the solutions do the quizzes.
Oh yeah, that's something that the TA should do. I'll get on his case to do it. Yeah, I think he's already done them, or he has to fix a couple of them. But thanks for reminding me. That needs to be done. Anything else? Yeah. So I'm going to talk tonight, like I said, about chapter 23. There's a good deal of qualitative knowledge in this chapter. There's a few math problems, not that many, and they're not that complicated. So what is a merger? It's when one company buys another, and then the company that buys now it doesn't give the vocabulary in the textbook, but you have the what's called the target firm is the company that's getting bought, and you also have sometimes the seller and also obviously the buyer. Most of the time, when it's in the case of a merger, what happens is, and it tends to be a bigger company that buys a smaller company, and then they just take that smaller company and just integrate it into their own operations. It's simple, but when you do something like this, you need to, there's different laws that whenever there's a major event in the history of a company, you need a, not just an approval through the board of directors, but actually a full shareholder vote. Consolidation is sometimes what happens is so-called mergers of equal. You'll have two companies that are coming together, and instead what they do is they create a new company, and then that new company takes in the two previous companies. There's a few different ways that a company can be taken over. The most obvious one is where one corporation just buys the shares of another. When you have a public company, which is most of the stuff that you look at in university, I do private stuff, so it's a little bit different. But as far as the textbook is concerned, we're only talking about public companies. A tender offer is where the company that's acquiring another makes a public announcement that they will buy the shares at a certain price. It basically goes through the stock exchange, but at the same time, now that you have electronic networks and so on, it's basically done in the form of a press release that goes on all the different news wires. Circular bid. This is in the old days. This is not something you would see so much nowadays, because you don't really see that much mail. But in the old days, what companies would do is take and mail a notice to all the different shareholders of a company that they were making an offer about it. Stock exchange bid communicated through a stock exchange. In reality, the tender offer and the stock exchange bid nowadays are really the same thing. When a company buys another, there's two ways that it can happen. Either the company buys so if you have company A, buying company B, there's two ways that it can happen. What's a share sale or a stock acquisition is where company A buys the shares of company B. An asset sale is where company A buys not the shares of company B, but it buys the actual assets, and then at the end of the assets, all the assets get transferred into the acquiring company, and then you're left with an empty shell, and then it's wound up. So in the case of a stock acquisition, it's where no stockholder vote required. That's from the point of view of the buyer. Obviously, the sellers, they have to approve. Now, the last one, just a small point. This is, I guess, originally this was a textbook that was made in the U.S. and then they made a Canadian version. So the last point's not quite right. Maybe delayed if some target shareholder hold out for more money. There's, in the Canadian law, which is the Canadian Business Corporations Act, there's a provision that if a company already owns, I think it's 90%, the last 10% have to accept the deal. So this is to, there's people that what they would do is, they'd end up with just like a small percentage, and then the company buying would end up, acquiring 95%, 99%, 99.5%. They had that one little pesky shareholder that would just, screw up the whole deal. So now there's these mandatory acquisition provisions so that if a company is buying more than 90% of the shares of another company, the remainder ones can't hold out. They actually have to sell at the same price. There's different types of mergers. Different reasons for doing them. Horizontal is when you have two firms in the same industry. Usually these are usually done geographically. I'll give you an example. One deal that we did at Sunbelt about a year ago was the biggest HVAC, so you know, air conditioner and furnaces and that kind of stuff, of Western Alberta. They bought the biggest HVAC company of Eastern Alberta, and they made a single one. So that's an example of a horizontal where usually the two companies that are getting together, they're, you know, one is big in a certain area, one is big in another geographical area, and then what happens is you end up with a big company that has a much larger market area. So it could be, you see that, for example, in you see a lot of those in banking. You know, Scotiabank has been for the last, I don't know, 5 years, maybe 10, I'm not sure how long ago they started. They've basically been going around the Caribbean and buying up a whole bunch of little banks in, you know, like Jamaica and Barbados and all these different places. So it's not like they're buying a company that does the exact same thing they're doing, but what they're doing is they're expanding their geographical market. Vertical is where you have companies that, if you look at a supply chain, so an example would be say if a car company bought a company that makes tires. So instead of then going and buying their tires from a supplier, then that you end up integrating that company into the main operations. Usually that's done to, if you have an industry where you have a certain resource that you need, and what a company can do is by buying a supplier, what they do is they lock in that resource for themselves and they prevent their competitors from using that. One that I saw a while ago was it was a trucking company. This is a story that happened in the U.S. And they bought a company that did washing of the inside of chemical trucks. And that was the only company that was licensed in that state to do that. So by that trucking company doing that, then all of a sudden, they were the only company that could legally operate in that state because they're the only company that could get their trucks washed by a place that had that special license. Another example of a vertical one was when Apple bought Siri. Siri was not something that was originally created at Apple. It was a different company all by itself that was making voice recognition software. So instead of Apple paying Siri to have the voice recognition software in the iPhone, what they did is they just bought it. So vertical in general is when a company buys one of their suppliers and they integrate that into a single operation. Conglomerate. This is something that used to happen a long time ago, but really doesn't happen much anymore. The reasoning back with that was if you had a company that was doing something, then and that was doing really well and was generating extra cash flow, what they would do is buy a completely unrelated company in a completely different industry, and the reasoning would be that they would diversify what their business was. In reality now, investors really hate those kinds of companies, and companies which are conglomerates tend to have a discount applied to them. In other words, they're worth, it's a rare example of the sum being worth less than each individual parts. So that's why you see a lot of companies nowadays, because investors, fund managers like to have these what are called pure plays, that the company does one thing. They don't like to have these companies that have a bunch of unrelated business if there's no synergistic reason to have these businesses together. So these used to be quite common, but they're less and less and less. So there's a couple of different ways that takeovers can happen. So you can do, like I explained, the merger, the consolidation. You can buy the stock, the shares, or you can buy the assets. Another one that you might have seen on the financial news are called a proxy contest, or the type of people that play in that world are called activist investors. So this a recent example in current events, not that current, happened maybe 6 months ago or a year ago, was Canadian Pacific, or one of the train companies. I can't remember if there's CP and CN. It's one of those two. And what investors were looking at was that company was operating nowhere near as good as other typical railroads in the industry. So what a proxy contest is where an investor, usually these are hedge funds or very high net worth type of individuals, and what they do is they basically fight with the management of a company. They buy a bunch of stock of the company, and then they fight with the company to replace the people on the board to make a direction in a change in management or a change in strategy. The thinking there is, the company is underperforming, so the stock is much lower than it should be. They buy a bunch of stock at a very low price. Then they fight. Using these proxies are the way that you elect directors on a board of directors of a company. So the activist investor buys a bunch of share at a price that's lower than it should be, and then they go about changing the management or making some major, or forcing the company to make a major change in their strategy through replacing people on the board. And then obviously the company does better, and then the stock goes up. So that's the whole proxy contest, activist investor game that a lot of people play. Going private is where you have a company that's public, and for whatever reason, it's more advantageous for the company to not be public anymore. I talked to you about when we did, I think, Chapter 15. Well, I think maybe, no, I did Chapter 15 in 2504. So what happens is, the problem with being public is, yeah, it looks cool, you got a stock on the stock exchange, but you have these quarterly earnings report, and so that drives the management to do these very short-term type of, to really look at the company from the point of view of the next 3 months, then the next 3 months, and the next 3 months. Sometimes in the history of a company, it's much better for the company to take that pressure off and go private for a while, fix itself, and then go back out public again. So you see that going private is where there's a takeover offer, usually by the management together with an investment fund, that buys all the shares that are on the public market, and then it basically takes the company back to private. This is something that makes sense when you're doing a turnaround type of situation. Now, as far as taxes go, there's something in the book. Obviously, if you go out in the real world, these are things that change over time. So, just because I tell you something is true now doesn't mean it's going to be true like 2 or 3 years or 4 years from now when you graduate. The tax system, tax laws change sometimes almost every year. So this is something you got to keep on top of. But if you have an exchange of shares and there's no cash involved, so in other words, the company A buys company B, but instead of paying cash for the shares of company B, what company A does is they issue new shares of company A, and then they trade shares of company A for the shares of company B. Then there's no tax implication. If, however, company A buys company B and they're buying the shares of company B with cash, then the people that own the shares of company B will pay capital gains. So if they bought, say, the shares at $10 and the and the takeover offer is for $20, then they'll have a $10 capital gain to pay taxes on. The purchase method, this is more accounting than finance. A company, at least a good company, should be worth more than the sum of its equipment. Right? That's true in almost all industries, probably except restaurants, because restaurants, I told you before, such a terrible business. Usually, if you take a company and you look at its fixed assets on the balance sheet, that might sum up to, say, $1 million. But the company gets bought for, say, $2 million or $3 million. Where does that valuation comes from? I will explain that to you next week. But it's usually things like a multiple of profit or a multiple of sales. So examples would be a typical range. Well, I'm talking more private businesses, but a company is worth about 3 to 5 times its EBITDA. For private businesses, obviously that's a very wide average because it depends on the industry, but a company is worth about half of its revenue. So if you have a company that's doing about $1 million in revenue, that company is worth about $500,000. But say that company only has $200,000 of equipment to generate that $1 million of sale. So, and that company is worth 500. So that difference between 200 and 500, that's what is called goodwill. So when company A buys company B, so company B has, say, 1 million in revenue. So company A buys company B, say, for 500,000, but company B only has 200,000 worth of net fixed assets. So that company A, the acquiring company, you end up with this goodwill line item in your balance sheet, and that's the difference between the purchase price, which is a valuation, usually as a multiple of profit, or usually multiple of cash flow, or multiple of revenue, and the difference to what the actual tangible assets are. Then goodwill is depreciated. There's some complicated tax laws on how it's done. It's 75% of the value. So there's complicated rules there. You won't be tested on that, but it just becomes another asset that's depreciated over time. And accounting standards change. For example, I think that the way that IFRS deals with goodwill is a little bit different than GAAP used to. So, like the general concept is the same, but the actual technical ways of how it happens, you got to stay up to date, and that's what you'll do after you graduate and get a real job. So let's show you an example of goodwill. You have a company, Parrot Manufacturing, purchases Clint for $120 million in cash. Clint's fixed assets are appraised at $95 million. And Clint Enterprise has working capital of $15 million and no long-term debt. So what that means is sorry, I made a mistake. It's not the net fixed asset value that's in the accounting statement, but it's whatever the fair market valued that equipment today. Because remember that you can have depreciation that's different than what you could actually sell the equipment. So it might be that a company has had equipment for a very long time, and it's showing that it's almost fully depreciated, but you could still get a lot more if you sell it used than what it's on the balance sheet at. What you use is what the fair market value is, meaning what could you sell it at today. So when you look at the purchase price allocation of a deal like this, you would say that the company paid $120 million. They paid $95 million for the assets, $15 million for the working capital, and $10 million for the goodwill. The goodwill usually comes from what are called the intangible value of the business, and that's usually, good, solid customers, diversified base of customers. What can be really bad for a business is what's called customer concentration. So, there's a story of a company in, I think it was Cornwall. They were selling something to the paper mill there. That was their only client. So when the paper mill shut down, then obviously that business now was worth nothing. So a company that has too much of its revenue coming from one or two customers, that's a very risky business. A company that gets its revenue from a lot of different customers is worth a lot more because there's a lot less risk that if just one customer goes away, it's not half of your revenue that's gone. So goodwill comes from things like, good employees, repeat customers, people that have been around. You've had customers for a long time, they pay on time, and so on. So synergy. There's the math part, and then the main reason to do a merger is to get what are these things called synergies. And what that is where one company buys another, and then when you put those two companies together, they're worth more than if they were separate. A lot of times, synergies come from cost cutting. So I'll give you an example in very, very little businesses. Flower shops. Flower shops are very difficult to be profitable if you just have one flower shop. But if you look, because whether you have one flower shop doing say 100, 200,000 in revenue, or if you have a flower shop doing $1 million in revenue, you still need to have a store. You still need to have somebody that manages the store. You still need to have somebody that answers the phone. You still need to have to have an accountant and so on. So it makes a lot more sense to merge a bunch of these and only have one accountant, one manager. So that concept shows up in a lot of different places. I'm giving you an example from companies that are worth like 50,000, and it's true all the way to companies that are worth 50 billion. When company A buys company B, if they have both the administration overhead, so they have an accounting department, have a marketing department, they need to have an office, they have to pay rent on that office, they have to pay heat and electricity and all that stuff. When one company buys another, what they do is they can merge that part of the business. They'll still have, say, the different locations, but they'll have only one headquarters or one accounting department. So you don't need two CFOs. You don't need two of everything. So that's a big one in terms of synergies is cost reductions. In terms of other synergies, does it have it a little bit later? Well, it's in that revenue enhancement one. And on the cost side, here's another example of a synergy. You know that when you go to a supplier, the more that you buy of something, the cheaper price you'll have. So if you have two companies that are buying, say, you have two companies that are making tires. So they both have to buy rubber. So one company was buying, say, 5 tons of rubber a year, and the other one was buying, say, 3 tons of rubber a year. So they would each get, not too great of a price. But all of a sudden, you have, if you merge those two companies, then all of a sudden you have a company that's going out and buying 8 tons of rubber a year. So they're able to get a much better quality discount on the input costs of the combined business. So that's another example of a cost synergy. In terms of revenue synergies, here's the biggest example. If you have a small company that has a great product, it often gets bought by a big company that has a big distribution network. So here's an example. Little companies say that makes like cable modems, or that makes some piece of a fiber optic network. Well, it would be quite expensive for them to have salespeople all over the world. So often with these little companies that invent a really great product, they end up being bought by a big company that has that distribution, that has that sales network. Another industry where that happens a lot is pharmaceutical. You have like a little biotech company that comes up with like a drug for like, say, skin cancer. But they don't have the marketing reach that, say, a Pfizer or a Merck does. So that's why you see a lot of the big pharma companies buying these little, because the big pharma companies don't want to take the risk a lot of times of developing their own drugs. What they do is they wait until a little company has a drug that's ready for market, and then they buy it and they put it through their distribution network. So that's an example of a revenue synergy. And advertising, if you have a bigger company, you're able to do a lot more. Let me just go back to the math part. So mathematically, the synergy, which is delta V, is the difference between the value of A and B put together, which is VAB, minus what the individual values of the business separately would be. Like I said, the reason why VAB tends to be bigger than VA plus VB is because when you put them together, say if you reduce the cost, then the company is worth more. If you have the same revenue, but the cost is lower, then you have more profit, and so the business is worth more. If you have two companies that you put together and now the revenue is higher, then obviously that is worth more than if they were separately. The synergy is the difference between those two. And the value of firm B, so that the value of the company getting bought, it will be different based on who the buyer is. Because there might be a certain buyer that looks at, there's a target company that wants to get sold. That happens a lot in private companies where you have an owner that's getting close to retirement. If you work for the government, you want to retire, you just, on Friday morning, you go and you fill in the form, the retirement form, and on Friday afternoon, you're out. If you own a business, if you spent your whole life building up a business and you want to retire, it's not that simple. So a lot of times what you see is the companies that are getting sold are usually the founder or the owner is 65, 70 years old, and they just want out. They want to retire. So once I say a company is for sale, it's not going to be worth the same to everybody, because the synergies are going to be different based on who the buyer is. So that's why we say the value of firm B, which is the company getting sold to firm A, is based on whatever the value of the firm getting sold is, which is VB, plus the synergy, which is specific to the company acquiring it. Because there might be, say you have one company that's getting sold, but you have two companies that might buy it. Well, if a company that is looking at it sees more synergy with their business, they're going to be willing to pay more for that business than a company that sees less synergy. So that's why we talk about the value of the selling firm to the buying firm. And it's going to be different for whatever the buying firm is, based on whatever synergy they see based on that the company that's getting sold. So let's do an example. You have Rudy and Blackstone are all equity firms. So in other words, there's no debt. Rudy has 1,500 shares, and Blackstone. Anyway, so from that you can get whatever the value of the two companies are. Blackstone is acquiring Rudy's for $36,000 in cash. The incremental value of the acquisition is $3,500. So incremental value, that's another word for synergy. So it's the value on top of the current value of the business based on what synergies the acquirer is going to have. So in this example, the current market value of Rudy is, what is it, $33,000. But because to Blackstone they see an extra synergy of $3,500, Rudy to Blackstone is actually worth more than just the value of its share. It's worth the value of its share plus the synergies they're going to get from the purchase, which is $36,500. I've already talked a little bit about this, and I've talked about cost synergies, but you also have revenue synergies. Strategic benefits could be something like I talked to you about before, where you might be able to knock out some of the competition by locking in a certain specific supply. Or it could be that it's a way for you to get to a whole new class, a whole new group of customers. So an example of something I've seen is there's a construction company that bought a company that was doing stuff for farms, that was selling like farm equipment. The reason being is that now instead of doing just construction for commercial building in the city, they want to get access to all the customers in the, to do building of farm stuff, so barns and things like that. Market power, it's, there's a lot of rules for where mergers would reduce competition, but these only kick in when it's a very big company. So the Competition Act, those kinds of things, they kick in if it's a minimum of, I don't know, 100 million in revenue or $1 billion in revenue. So you do see in the smaller business, you see a lot more of that going on. There's one guy that I know, what he did is he built a company that was quite successful making pools in the kind of Ottawa Valley, like Smith Falls area. Because what he did is anytime another company would try to do this, he would just go and just buy them out. So he would end up being, the only company that did pools in that area. So that's the kind of market power strategy that mergers can be used for. In terms of other types of cost reductions, larger quantities while reducing the average per unit cost. So that's, say you have this would be an example of that. It could, yeah, well, that's true in industries where you have very high fixed costs. So I'm guessing an example there would be if you're a company in the making aircraft. Yeah. Just the fact of combining and having just a single factory could allow you to reduce your unit cost. Vertical integration, I've talked about that a little bit before. That's true a lot where you have a resource which is really key to the success of another one. I think the most hilarious one that I've seen in recent years was an airline, I think it was Delta, buying a refinery in New Jersey. Just the reason being that it had been such a hassle and the prices go up and down over time for them to get their jet fuel. So what they did is there was like a little refinery that was near the Newark airport, and the company that was running that refinery, I think it was Shell or something like that, was trying to get rid of it, and they actually sold it to an airline, and that airline was using then that refinery just to make jet fuel for their planes that were coming in and out of the New York area, because it had been such a hassle. When there's shortages, then all of a sudden the suppliers crank their prices, or they're never quite sure if they're going to sell. Do you have a question?
Yeah, about vertical integration. I understand how it's like an airline company doing that, but for example, let's say like Shell or BP, that their main job is actually drilling for oil.
Yeah.
Is that would that actually be considered vertical integration for them as well, even though it's in the same industry? Like if they buy the
If one buys another one that's exactly the same, that's called a horizontal merger. So in the oil and gas, what's an example of a vertical thing? It could be, say, that BP buys a company that makes drill bits for oil rigs. It's just a vertical merger is any time that the buying company, the company that's buying, what they're buying is something that's a supplier in their business. And so it could be just about anything. It could be,
related to the business itself. But it still has to be somehow related to the business itself.
Yeah, where instead of paying a supplier to do that, so another example would be, say, if Loblaws bought a trucking company, so that instead of paying a trucking company to move their stuff around, they just, instead of having them as a supplier, they then own that company and they integrate that into their operation. And so you have, tighter, these kinds of things work where you have issues with, like, having good suppliers is a really big key, like, success factor for a business. So what you do is you buy that supplier and you put it inside your own box so that you can control it a lot better and they don't sell to your competitors. So anytime a business buys something that supplies them either a service, a product, a raw material, anything like that, that's a vertical integration type of thing. You see lots of those. Complementary resources. In the bigger ones, sometimes you see that. You see that a little bit in the smaller end, where if you have a business that's seasonal, say you have a company that owns, say, a ski hill, what they'll do is they'll buy a golf course that's nearby. So that, say if they have a hotel, then they use the hotel for ski stuff in the winter and then golf stuff in the summer. So complementary type of stuff, you see that a lot with seasonal. Or it could be, what's another, can't think of another example right now in that area. As far as economies of scale there's an optimal size. In reality, the actual picture doesn't quite look like that. Because most of the time, the bigger you are, the better it is, because things get cheaper and cheaper and cheaper and cheaper. So when you look at economies of scale, in reality, the actual picture looks closer to this. The bigger you get, the cheaper the cost is, but then it gets to some point where being too big just kind of goes back. But that optimal point is usually very, very far out. It's not, it looks like, you know, right in the middle or something where it's fairly easy to get above a size where you get to this economies of scale, but I'm telling you, for most businesses, that's why businesses get so big and they buy other businesses and they scale up and up and up and up. It's because economies of scale are very strong drivers for costs to go down. So it's like you can just do this forever. Very rare that you get something where it curves back up. It's usually just better to get bigger and bigger and bigger and bigger. The point where it starts to curl back up is usually very far at a very, very high scale, if it's there at all. Some taxes, some tax issues with mergers. Now, there's been, now IRS is like the Canada Revenue Agency, CRA. That's the US version of it. But if you have a company that has losses, then you can carry forward those losses against future profit. So what used to happen a lot in the past is companies would buy a company that was very profitable, would buy a company that had a lot of accumulated losses, just so that they could merge with them and then use their losses against their profit. So after companies doing that for a very long time, the tax laws have been changed, so now it's much tougher to do those types of things. At least in Canada, the only way you can do this is if company A is buying company B and they're going to use the losses against their profit, they got to be in a similar business and they got to be continuing the business of the losing company. So it couldn't be, say, an oil and gas company buying a restaurant that has a whole bunch of losses so that they could apply the losses against their oil and gas profits. So there's a lot of the tax laws have been tightened a lot against companies just buying another company just to take their loss carry forwards. Surplus funds, unused debt capacity. Sometimes what a company will buy another company just because if a company is under levered, so it has a much lower debt than what the optimal debt, say, in that industry is, and that happens more in horizontal mergers. What happens is the buying company will buy, the buyer will buy the seller, and then they will have, by putting the two together, they will be able to borrow more because the company B might have a lot less debt, so they might have, say, $1 million worth of assets, but they only have, say, 100,000 of loans that are secured against those assets. So one of the advantages to the buying company is to use that extra borrowing capacity of the seller once after they combine the operations. If there's surplus funds, well, that comes more to what are the options of a company that's generating a lot of cash flow, which is a nice problem to have. You can pay dividends. You can repurchase shares. Those are two ways of flowing cash back to shareholder. But another possibility is to buy another firm. Asset write-ups, that has to do with when a company buys another and they're doing an asset sale instead of a share sale, then what you do is you get to bump up the value of the UCC in the depreciation schedule. So here's an example. You have a company that buys another company that the equipment originally, say, was bought for $1 million, but now it's been depreciated, say, to $200,000, but it could really be sold for, say, 400,000. So when company A buys company B, the UCC value gets readjusted to what the current fair market value of the asset is. So that's what asset write-up is. That has to do with tax and depreciation. Now, the first thing, not always true, because usually working capital is tied into a specific operation. So say if you had two retail stores that merged together, you still would need to have the same inventory in each store. So where it says a merger may reduce the required investment in working capital and fixed assets relative to the two firms separately, that's actually pretty rare. The second one is a lot more common. I explained to you that if you have two companies that each have their management overhead, they each have an accountant, they each have a receptionist, all that stuff, then once they're run as a single thing, then you can manage the assets a lot more effectively as a single thing. And what happens is sometimes when two companies get together, then you end up with what are called redundant assets. So there's, if the two companies have, say a very simple thing, say a small business, each company has a printer. Well, once you put them together, you only need one printer in the company. So the extra assets of the company getting bought are called redundant. So you can use those and sell them and then turn them to cash, and that generates some of that merger synergy again. So that's the first point. That's true throughout the course. Book values on the accounting statements usually, they can be quite different from what the reality is. So the example is where you have something that you've depreciated on your balance sheet a lot quicker than it's depreciated in real life, or vice versa the other way. So you never use the actual book value of something. You use what the market value is. When we look at mergers, we're looking at incremental cash flows. That's just like everything we've done in this course. And you have transaction costs. Let me see. Does it say it in the next slide? But basically the punchline is that, well, transaction costs can be pretty high because number one, well, that's how a guy like me gets paid. And we charge, when one company gets bought by another company, the selling company pays a pretty big commission. And, you got to pay lawyers to do the agreement, and you got to have an account. You got to do. The buyer has an accountant that goes over the selling company's books, and so these transaction costs can add up quite a bit. The point is that what you want is to have what the synergy is going to be has to be higher than what the transaction costs are going to be. So say our commission is going to be 100,000 on something, but the company buying the other company is going to get 250,000 of synergies. So after they pay us their commission of 100,000, and then they pay maybe 25,000 in accounting and legal fees, but they're getting 250,000 of synergies. That's where it makes sense. But you have to look at these transaction costs. So when you look at the net present value decision of a merger or not, you look at what am I going to get in terms of benefits, but minus what the costs are going to be. Okay, there's 2 more slides and then we'll take a break. So in the old days, like I talked to you about, the where you had these conglomerate type of mergers, the reasoning behind that was diversification. Nowadays, that doesn't work so well because investors, either funds or individual investors, they can just diversify by themselves. So they don't like companies that are put together that have no relation to each other. That's why diversification by itself is not a good reason for merging 2 companies together, because the diversification is achieved by the investors in their portfolio as opposed to the investor owning a single company and then that company has multiple businesses. No, that's what the second point says. Earnings per share growth. That's, when you're a giant company and you're making already, billions of dollars in revenue, it's hard to do, 10%, 15%, 20% growth in sales or earnings. So what big companies do is they go, because once you're a big company, it's pretty difficult to grow your sales at more than GDP. But the way to go get growth is to go and buy other companies. Sometimes, if there's no synergies, the growth in earnings per share, it's just, there's some people that run public companies that are a little bit, what would I say? Unethical is a little bit too strong of a word, but what they're trying to do is they're trying to make their company look good by buying other companies instead of developing new products internally. Because it gets to a point, there's something weird that happens with companies. Once they get to a certain size, they lose their original entrepreneurial spirit, and it's very difficult for them to keep growing at the rates that they have before. So what managers of those companies tend to do is they tend to go and buy innovation from other companies somewhere else and then merge that into their own company. And that's how they increase their sales, not by coming up with new products on their own. So here's an example of a post-merger EPS. So firm A is merging with firm B. Firm A will pay firm B's stockholder the current value of their stock. And all right, so let's look at so if you look at firm A will pay firm B stockholders the current value of their stock in shares of firm A. So this is a stock deal. So firm A is creating new shares of A in order to buy the shares of B. So the change in shares of company A is going to be whatever the value of company B is divided by the price of the shares of A. So firm A is going to issue 1,350 shares, and that's what they'll give to the shareholders of B for the 1,800 shares that they have. So now, the earnings per share after are going to be the earnings of A and B put together, which is $6,500. But now that 6,500 will be spread across the 2,300 shares that A had before, plus the 1,350 that they added. So after the merger, the earnings per share of A are going to be $1.78. Yeah.
Is it usual that they pay exactly the market price of the share? Because here the market share is 15 and they pay 15. Do they usually do that? Or?
Well, usually there's a premium, a little, because you want everybody to accept the offer, or at least you need to get, depending on different countries, different jurisdiction, you need to get either to 100% or 90% or 95% of the shareholders of B need to accept that deal. So you're right. Usually what A is going to do is make an offer at a little bit more than 15 to motivate all the shareholders of B to accept the offer. So there is a premium. I'm going to show that in a little bit. All right, so here's a good time to take a break. Okay, it's 7:30. Let's continue. So now I'm going to do a little bit more math, a little bit less theory, and it's what we're trying to get to is looking and deciding whether you should do a merger or not. So, like everything else we've done in this course, it's about looking at the net present value of a decision. So you look at the different cash flows, and in this case, what the cash flows are, what you're receiving is the value of the business of the target company plus the synergy minus what it's costing you to acquire. So if it's costing you less to acquire than what the value of the business is, including the synergy, then you have a positive net present value. The merger premium, which we were talking about earlier, that's the difference between what the cash offer for the shares of a company is and what the current market value of a firm is. So say if you have, the shares of a company are currently trading at $20, it doesn't make sense for a company to offer $20 because what's going to happen is some of the investors are going to think, well, I'm better to just hold on to those shares and hope that the market price goes up. So the way to motivate the holders of the target company to sell their shares to the acquiring company is by offering more than what the current stock market price is. The difference between what the offer is and what the current market price is what's called the merger premium. So it's a value, it's a dollar value above what the current trading price of the share are. So if we look at remember there's two ways to, there's two things you can pay that a buying company can pay can use to pay for the shares of the selling company. They can either pay in cash, which is the example there, or the one we're going to do in a bit, is they can pay using their own stock. So this is one of these where they'll say we'll pay for 2 of our shares for 1 share of the acquiring company. So those are two different ways of buying the shares of another company. So I'm going to look first at when company A is buying company B and they're paying cash for the shares of the company that they're acquiring. So we want to know what is the net present value of the cash acquisition. So in this case here, so when Solo looks whether they should buy Alto or not, what they're going to look at is what is the value of Alto to them which is composed of the current value of Alto plus the synergy minus what they're going to pay for the shares. So in this case, the current market value of Alto is 2,400 shares at $24. The synergy is 5,500, and they're offering 63,000 for it. So meaning that the net present value of the acquisition is 100, which is positive. Let's look at another example. This is a cash acquisition price per share. So what we want to know is what is the price per share of the buyer after they acquire the seller. So we want to know what is the price of the combined business, so P, A, and B. So that's the value of A and B divided by how many shares the combined company is going to have. So that's the value of A plus the net present value of the acquisition. But here's a key thing here. The SAB is going to be the same as SA, because in this case, they're not issuing additional shares. So even though you will have the combined company in VAB, you will still have this A or AB put together will still have the same amount of shares as before. So here the value of, source, I said VAB, that should be so the value of secondary is 2,500 shares. They have the same amount of shares in both cases. Oh, wait a second. I think I made a mistake in my solution here. Oh, no, that's right. This the value of the, sorry, it's the value of the acquiring company plus the combined thing. So principal gets 4,500 of incremental, the net present value from doing that acquisition, and then they will have 2,500 shares as before. So the price per share of principal after the acquisition will be $31.80. You can see that the rise in value of the shares from 30 to 31.80 is based on the synergy which is captured in the net present value. Remember, the net present value is the synergy minus the cost. So if a company does, and by the way, you'll hear that expression accretive, right? You'll hear that on the business news. Is that an accretive acquisition? Meaning that there is positive synergy, and so the buying company, by doing this, will increase their share value by the amount of the net present value distributed over the shares. So the shares go from 30 to 31.80, and where does that 180 come from? It's that net present value of 4,500 spread over the 2,500 shares. Okay, this one's about the merger premium. So the merger premium is the value of the cash offer above what the current market value of the target company. You'll hear me use that expression. Target company is the same as the company that's getting bought. So in this case, the cash offer is $58,000. And the current market value of Jennifer's is 2,100 shares at 26. And so the merger premium over the whole deal is $3,400. So the merger premium per share, I'll use an abbreviation here. That's the merger premium divided by how many shares Jennifer has. So currently the shares of Jennifer are trading at 26. But if Sally's is offering $58,000 for all the shares of Jennifer, that means that they're offering $27.62. So Sally is offering the shareholders of Jennifer $27.62 per share of Jennifer. And that's what, did you have a question?
Yeah, the information on that is just useless. It just confuses.
Well, if there's neither firm has debt. If there was debt involved, then when a company buys another company, they also have to pay off the debt. So you'll see it's just because this is kind of there's a more advanced merger course that you can take here. I think it's either a third year or fourth year course. It's actually quite good. It's taught by I'm trying to remember the guy's name, but he's a really good prof. Can't remember his name now. But the guy that teaches the merger course is actually quite good at teaching the merger course. And, there's a little bit more complications. But in 2505, it's just a second year course. It's just, one chapter of the course. So that's why we always say, the companies are all equity or, both firms have no debt. It's just to simplify just the basic, to look at the combination of the shares together without the complicating issues of debt. Because if if Sally bought Jennifer for $58,000, but say Jennifer had $50,000 in debt, then there'd be only $8,000 left to pay for the shares. That's nowhere near what they're worth. So it just simplifies the argument. That's why in all the problems in 2505 it says the companies don't have debt, just to simplify things. Okay, so next let's look at what happens when Company A that's buying Company B, instead of paying cash for the shares of Company B, what they do is they pay using their own shares. You see that more in bigger deals because that's quite risky. It's a lot less risky for a company getting bought to receive a cash payment than it is to receive shares in the company that they're getting bought from. Especially if you look, say, more like a smaller private business. Once the company gets bought, your company gets bought, you don't have control about how the company that's buying your company, how well they're going to run it. So if you're getting paid in the shares of the company that's buying you instead of cash, that's more risky. But that makes more sense when you have fairly big public companies. You see a lot more of those. And those happen a lot when you see a lot more of those deals happening when the shares of the buying company tend to be overvalued. If the managers of the buying company see their shares as overvalued, then it makes sense for them to use that as a currency to go buy other businesses. So that's why in the dot-com days, you saw a lot of these all-stock deals because the dot-com valuations were just completely crazy, and the companies weren't making that much cash, but they were using their overinflated stock price of the buyer company to use that stock and buy another company with. So you see a lot more of those going on when you're in a period of high valuations in the stock market. The cost of acquisition, well, when you did a cash deal, it was pretty simple. It was just whatever the cash you paid for it. When you look at the cost of acquisition when you're looking at a stock deal, that you have to look at how many shares the buying company has to issue to buy the other one, and whatever the price of the combined company put together. So if it's accretive or not, and so on. You'll see it makes more sense once you start to see some examples. Oh, a couple of some considerations why you would choose between cash and stock. Sharing gains. The target stockholders don't participate in the stock price appreciation with a cash acquisition, but they do with a stock acquisition. The other reason why you would do a stock acquisition over a cash acquisition is if you do a cash acquisition, you trigger a capital gain on the shares of the selling company. So the shareholders of the company getting bought might prefer to get a share-for-share exchange because in that case, they don't get hit with a capital gain. Cash acquisition do not dilute control, but they can with stock acquisition because if a company has to issue a bunch of new shares to buy another company, then remember when we talked about dilution, right? If you have all of a sudden more shares in a company, then the people that own a certain percentage before will own less after. So if you have, say, for example, that's one example why big family companies will tend to go with cash acquisition instead of stock acquisition, because if they do a stock acquisition, they need to issue new stock to buy the target company. Then all of a sudden, the controlling group might not have 51% of the shares anymore. Say you have, a family, a pretty rich family that owns, the majority of the shares on a publicly traded stock. They own, say, 51%. But once they, say, have to issue, 10 or 20% of new shares to do one of these share-for-share exchange, all of a sudden they don't have the 51 anymore. So that's a disadvantage of stock acquisition is you dilute the current shareholders. But if you do a cash acquisition, whatever group had control before, the number of shares of the buying company in a cash acquisition doesn't change. So if you had a controlling group that had 51% before the deal, they still have 51% after. Let's just start with a simple example here. So we're talking about share-for-share exchanges now. Another word for those are stock acquisitions. So you're acquiring the company using your own stock as opposed to using cash. So in this case, Baker is buying Good Day and Son. So they're paying $19,000. And here's the key here. They're paying $19,000, but using the share price of the target company. Of the of the buying company. So they're going to pay $19,000 for the shares of Baker, but they need to have. They're paying using shares. Their currency, in other words, is their own share, and that currency is worth $25 a share. So they will create 760 shares. So Baker will have 760 more shares after the deal. Just think of it in a simpler way. Say if you're buying a company for $100,000 and your shares of the buying company are worth $100, you're going to need to issue 1,000 new shares to buy that, to pay the shareholders of that other company. So the shareholders of the buying company, of the selling company, they will receive those 760 shares in exchange for, so the Good Day shareholders, they currently have 1,000 shares in Good Day. After the deal, they will receive 760 shares for those 1,000 shares. So you got like a ratio of what, 0.76 shares, pre to post. What is the stock acquisition value to the acquirer? So that's the so the value of Winslow to Furrier, I'm not sure exactly how to pronounce it, but that's going to be whatever the market value of Winslow is plus the synergies. So what is the value of Winslow? There's 1,000 shares at 22 plus the synergy is 4,000. So the value of Winslow to Furrier is 26,000. So I think that's the same deal, yeah. So if you look at what is the merger premium per share? That's going to be whatever the offer is minus the value of Winslow. So the offer is for 25,000. So in this case, Winslow has a current market value of 22,000. Furrier is offering 25,000 for it, and there's 1,000 shares out there. So the merger premium per share is $3. So what that's saying is Furrier is offering $25 a share to the shareholders of Winslow. Now the actual cost, that's one of the That's probably the most. This chapter is not that complicated, but that's probably this one the most complicated question that you have in this chapter. When you look at what is the actual cost, what you need to do is you need to figure out first how many shares the acquiring company needs to issue, and then you look at the value of the combined of the two companies put together, and so the actual cost is going to be based on whatever the value of the shares after that deal is. Let me do it. It's going to make so Y is the buyer, X is the seller. So Y is going to issue 875 new shares, and they're going to give those to the shareholders of firm X. So when you look at the value of the combined company, it's going to be the value of X plus the value of Y plus the synergy divided by how many shares you have, Y is going to have after the deal. So in this case, it's 2,000 times 16 plus 1,200 times 40. And then you will have 1,200 plus 875 shares. So the price of the combined company, the price per share of the combined company is $39.76. And so the actual cost to Y is the number of shares that so it's costing Y. That's a key point here. You look at how many shares they need to issue to buy the shares of the target company, and you multiply that by what the value of their shares are going to be after they combine the two. That's what the actual cost to the buying company is. 479, yeah. Now, obviously there's some companies that don't like to be bought. Usually that's where you end up with, that happens a lot where you end up with an agency problem. That's going back to chapter 1 and 2504. Remember where you have a conflict between the owners of the company, so the shareholder, and the management. So sometimes you end up with managements which are, overpaid, and they just have, lots of perks, and they have the control, but they own a very small part they own very little percentage of the company. So they prefer to vote themselves, big salaries and so on. What I would say unethical, again, is a little bit too strong of a word, but what sometimes happens is company will, and that's more the management of a company that tends to do that than the shareholders, because it's most advantageous for shareholders to have their company to be allowed to be bought by as many other companies as possible, because that's how a lot of times through that premium, that's how as a shareholder you tend to make money is when the shares that of a company that you own gets bought by another at a premium, and you make a nice big return on your investment. So it's always better from the point of view of a shareholder to own companies that don't have these defensive tactics against getting bought, because when a company has these defensive tactics, things like supermajority. So you might have something in the company's bylaw that says, in the case of a takeover vote, then instead of 51% of the shares of the vote it has to be, say, 2/3 or 75%. What that does is it reduces the amount, the possibilities of a company getting acquired, and that actually lowers the value of a company from the point of view of the shareholder, because by reducing the amount, the number of potential purchasers, it reduces the odds of your shares getting bought at a premium, and so shareholders tend to really hate those types of defensive tactics. Now, there's some of these, targeted repurchase and standstill agreement exclusion. You can read about those in a textbook. Yeah.
Isn't there the delta T missing in the equation here? Because I did that on calculation.
What do you mean
The
the?
synergy in the-
Oh, sorry when I wrote it out.
Because you add the x and the y.
Oh, sorry, I must have. Yeah, sorry, I forgot the. The increment. Yeah, so there should be a 2,500 here. Does that still? Can you check? Because I think it's probably when the TA typed it out that he missed that part. So I'm pretty sure it should be. Well, you can check. I'll come back to it.
Yeah.
So when you include the 2,500, you get the 39. Yeah. So it was just an error in the typing. All right. Some more of these defensive tactics. You have these things called poison pills. These are they're less and less common because you'll have sometimes those are in the bylaws of the company that say, for example, if a company receives a takeover offer, then the current shareholders have a right to, issue. The board has the right to issue an unlimited number of shares to current shareholders, and there's all kinds of dirty, lawyer tricks that I've used in the past. But nowadays, a lot of those have been cleaned out. You don't see that so much anymore. Things like other defensive tactics, golden parachute. That could be because here's one of the main reason that a management, we're talking about public companies and fairly big public companies, one of the reasons why management of a company does not want to get acquired is because when company A buys company B, the management of company B loses their job. So the management of company B does everything they can to make sure that they don't. And that's where you end up getting the divergence between, let me just finish my sentence. That's why you end up getting the divergence between the interests of the shareholders and the interests of management, and you have one of these agency problems. So, yeah, go ahead, ask your question.
Do you sometimes do takeover firms especially state they'll give managers a severance, a really healthy severance, whatever, to maybe lessen the.
Yeah, here's the problem there, is that a lot of times it's these very close kind of chummy board of directors that vote. It's they're golf buddies or something like that, and the directors vote, the CEO and the CFO, these, golden parachutes that if the company gets bought out, they get like a huge severance package. You see less and less of that because these are kind of 80s and, a little bit to some degree, 90s type of things. As corporate governance gets better and better in public corporations, you see less and less of those shenanigans going on because, shareholders have learned their lessons over time. Because if you have, if a company A is going to buy company B or company C, and company B has all kinds of problems like that, it's going to be big legal fight, all that to buy it, and company C doesn't have any of those problems, well, obviously company A is going to go buy company C, and the shareholders of company B are the ones that end up getting screwed. So over time, there's been enough of these problems that corporate governance has gotten a lot better. And nowadays, shareholders just don't let management get away with some of these things. So yeah, it's in the textbook, but you see a lot less of that going on these days. Probably the only one that's common now, I would say, in modern times is the white knight. And what that is if company, that happens in hostile takeovers, where the company B doesn't really want to get bought. But company A makes a hostile bid for company B, and so what company B does is they really don't want to get bought by company A, so what they do is they go and they try to get bought by some other company. And that's where the expression white knight comes from. So, company A makes a hostile bid for company B. Company B doesn't want to get bought by A, so they find this white knight, this other buyer that they would prefer to be bought from. Normally, they would have never sold. They would have never merged with another company. But because this company A is now hostile and trying to take him over, what they do is they say, well, if we're going to get bought, we'd rather get bought by a friendly company. So they go and they got bought by another one. They'll go to company C and say, hey, would you like to buy us? Because we'd rather sell to you than company A. So that's what white knight is. But the rest, crown jewels, it's an old defensive tactic where the company that's getting a hostile bid, what they do is they just take some good part of the company and they sell it to use the cash to defend themselves, or they sell the part to someone else that the other company was trying to buy them for to get the hostile bid to go away. But like I said, if you have better corporate governance, and if you have independent directors, and you don't have these very kind of incestuous board of directors that are very chummy with management, if you have a proper independent board of directors, a non-executive chairman, those types of really good corporate governance practices, you get a lot less of these, shenanigans of defensive tactics. Because from the point of view of the shareholders, it's good for your company to be taken over, because you end up usually getting a merger premium over what the company is currently trading in the market. So shareholders love for their stock to get bought over. It's the management of company that are entrenched and try to defend themselves. But with good corporate governance, you don't end up with these problems. Now, a little bit of evidence on acquisitions. The shareholders of the target companies tend to earn excess returns in the merger. Here's one of the reasons being here is that the shareholders of the target company, in other words, the company that's getting bought, they get paid the merger premium, which is based on what the acquiring company thinks they'll do in synergies. The reality is, and that's more true with much bigger companies, that when you're talking about multi-billion-dollar takeovers of big public companies, is the integration of the two very often doesn't go as well as you thought it would. And a lot of synergies that you thought you would have don't work out as well. And you end up not getting as much post-deal synergies as what you had estimated before. But you did pay the merger premium to the shareholders of the company getting bought. So the reason why the excess returns get captured by the shareholders of the target company is because the estimated synergies, which get paid for at the deal, turned out to be less afterwards. So the shareholders of the target company get that full benefit, but then the shareholders of the buying company don't end up receiving the full benefit of that merger because the synergies that maybe they thought was going to be, say, 20 million only end up being 3 million. So that's why it's usually better for shareholders to be on the seller side of a deal than the buyer side of a deal, because the risk ends up on the buyer side on whether those synergies come out to the full value that was estimated before or not. So that the whole point I was making is the first yellow point there. Anticipated gains from merger may not be achieved or not fully. They don't turn out as well as people thought it would. The next one, bidding firms are generally larger, so it takes, if you're like, Apple, it's pretty hard for Apple to do an acquisition where it's actually going to move the needle at all on, I think Apple by now could buy like 3 Microsofts, right? Or once a company gets very big, think of maybe say like the second biggest company in the world, ExxonMobil. They would have to buy almost every oil company in Canada, and that would add maybe like a decimal point in their earnings. Right? Once a company gets very big, it's very hard to do acquisitions that are big enough that will actually make a difference. And so what happens is a lot of these big companies, they really push the envelope. They really try to do these deals, and they end up sometimes doing. They're trying to do bigger deals. Obviously, the bigger the deal you do, the more risk you have, and sometimes one of those doesn't work. And that's why it's much better to be bought than it is to be the shareholder of the buying company, of the selling company, than it is to be the shareholder of the buying company. Some other specialized types of mergers and acquisitions, or just generally, deals. Divestitures it's the opposite of a merger. It's say where you have a company that gets rid of a certain part of its company. So it could be, what's an example that I can think of that's happened lately? Well, I can't think of a current event example, but let me just in general give you a situation where that could happen. If you have a company that buys another company, so company A buys company B, they might end up with parts of that business that they buy that they don't really want. So it could be, for example, a bank buys another bank, and they're buying that other bank because they really like, say, their wealth management division, and that wealth management division has a really nice client list, and they really want to, get those customers. But that bank that they're buying also has a bunch of branches in, say, Florida, where the Florida market is really terrible. So what they'll do is they'll buy the bank that has the part that they want and the part that they don't want. And then after they're done buying that, what they're going to do is take the piece that they didn't really want to buy in the first place, and then they'll just, it's called divest. So they'll just sell that subpart to somebody else. So that's happened where, I think I've seen deals where Canadian banks have bought, something in the U.S. because they were trying to get, a certain part of what a certain, division, or there was a big part of the bank that they were buying that they wanted, but there was parts that they didn't want. So they would just get rid of the parts that they don't want. Or sometimes it could be a company that, trying to think of a company that has just done that by themselves. They've been in that business for,
Would, after the financial collapse, when Citigroup basically had a few good areas of its business and then just sold its credit card and other businesses?
That's an example, yeah. So, you might have a bank, that's a good example, that does everything. And then all of a sudden, they get a management change, they get a new CEO, and that CEO says, that credit card division really sucks. So what I'm going to do is I'm just going to get rid of it, but I'm still going to keep the good parts. And so that's an example of divestiture. Right? You take one of the divisions, one of the businesses that you have in your company, and you sell it to somebody else. Usually that makes sense when it has become not a core thing to what you're doing anymore, but it makes where somebody else might be able to run it a lot better than you can. So it could be that, the example of a credit card. They say, well, we're not very good at, running call centers, but we're really good at having, branches in neighborhoods and doing mortgages. And so we'll sell the credit card business to somebody else because that somebody else is willing to pay good money for it because they'll be able to run it better than we can. That's where divestitures happen. It's usually when a company realizes that there's a certain part of their business that's they could get more money for than what it's worth if it was still running within themselves. Equity carve-out, that happens where, say you have a very hot division in your company, and the two parts of the business are being valued at different multiples. And what you want is you want to create shareholder value by separating the two. An example that's happened was phone companies that would have landlines, the stuff, with the wires on the poles in the ground, and they would also have cell phones. And they were making, the division that was doing cell phones was making a lot more money than the division that was making landline, because that's a slowly, decaying, dying business. So what they would do is they would just take the mobile business and just take that and make an IPO and create a separate company and IPO that, and then they take the cash from that IPO and pay back their shareholders. So that's an example of an equity carve-out. A spin-off is it's similar to an equity carve-out, and distribution of shares in the subsidiary to an existing parent company stockholder. What's an example of that? Can't think of one. It's it's very similar to an equity carve-out, except that instead of doing it through an IPO, what you do is the shares of that separate business. Say you're the shareholder of Telco, and then it's got it's got a landline division, and a mobile division. You could put the mobile division through an IPO, or what you could do is take the shares of the mobile division and just give it to your shareholders, and then they can sell them or not. The equity carve-out and the spin-off are really the same idea. It's just one of them, it's done through an IPO. The other one is done through the shares of that division that's getting divested are just given in proportion to the shareholders of the parent company. Split up, that happens, like I said, investors now tend to prefer pure play type companies. And so a lot of times what made sense to put two businesses together, say a long time ago, doesn't anymore. I think there was an example of a big split up. I think Kraft did that, where they split their snack business from their drink business or something like that. That happens more and more because investors in general prefer to have businesses that are pure plays, and they don't like to have combined businesses that are combined when they're not. They shouldn't really be together. There's no benefit to having the two together. All right, so here I'm done the new material for this chapter. I have a couple of more examples. There's no new material, so I'll take just a quick 5-minute break if you want to leave, and I'll just show you more examples of what I've done tonight. All right, so here's an example of goodwill. So you have a company that has $3.8 million in net working capital, no long-term debt, and fixed assets with a book value of 32.4 and a market value of 36.1. Here's the important point. When you look at goodwill, you look at the fair market value of assets. So you don't look at whatever the book value is. You look at what the current fair market value is. So the important number there is 36.1, not 32.4. So if All Metal buys Metalworks for $42.5 million in cash, that will create $2.6 million in goodwill. Goodwill is only created in accounting. It's only created when there's an actual transaction. A company can have goodwill, but a goodwill item only shows up on a company balance sheet after an actual transaction has been done. So a company always has goodwill, at least a good company has. A company should be worth more than the sum of its equipment. And most companies are, right? Because the value of a company is usually a multiple of cash flow. The asset value of the company is whatever the depreciated value of its equipment is. And most companies are usually worth more than just the equipment, right? There's some kind of magic, glue that value of, the only example is well, not really the only example, but there's two main industries that I can think of where there's very little goodwill. One is restaurant. A restaurant is usually worth no more than the value of the kitchen equipment and the table, the chairs, and whatever food and booze inventory it has. Almost no restaurants have value above just what the equipment is worth. The other one is the golf courses. The reason for that is that a golf course has to have a lot of land, and especially golf courses that are close to cities or within cities are usually worth more, ripped up and turned into houses than they are for the actual revenue and profit that the golf course generates, maybe through membership and through green fees. And remember that a golf course usually makes a big part of a golf course business is actually a restaurant business or a bar business, which those are usually not worth that much in goodwill. That's why golf courses are rarely worth more than the land, just the land that it sits on. It's rare that a golf course makes enough profit for it to be worth more than the money you would make from just, turning the whole thing into houses. In other words, a golf course is rarely worth more than its real estate. And a restaurant is rarely worth more than its equipment. Okay, so let's look at an example of the value of firm B to firm A. So this is the value of Lily Star. This is the value of Lily. L plus the value of the synergies. So you have 1,500 shares at $12. And the synergies are worth 3,100. But here's the key point. The synergies are specific to who the buying company is. Because, what is it? Who's buying who? Specialty Shop is acquiring Lily for $20,000 in cash. To Specialty Shop, Lily is worth $21,100 because Specialty Shop sees $3,100 in synergy with LilyPad. But to another company that does not see that $3,100 in synergy based on what their operations are, then LilyPad is not worth as much. So typically, in a takeover situation, the company that ends up buying the buying company that ends up buying a selling company is the one that sees the most synergy with their current operation. Because to them, it's worth more to them, they're willing to pay more. So here, this is an example of what the post-merger's earnings per share are going to be. So in this type of question, what you need to know is, to know what the post-deal earnings per share is, you need to know what are the earnings after and what are the number of shares after. So you need to figure out how many extra shares So in this case, this is a stock deal. So A is going to have to issue 1,500 shares, and they will pay the shareholders of B will trade in their 2,100 shares of B for 1,500 shares of A. So after the deal, you're going to have 8,200. So the two companies put together are going to have earnings of 8,200, and that 8,200 is going to be distributed across the number of shares that the buying company had before, plus the new shares that they need. Sorry, that's not 1050. That's oh yeah, it's 1050. It's here that I got it wrong. I had the 5 in the wrong place. So this is an example of the net present value of a cash acquisition. So the net present value of a cash merger is the value of the target business to the acquirer minus what they're going to pay in cash to do it. The value of the target business to the acquirer is the market value of the target plus the synergies they're going to get, and then minus what they need to pay for it. So in this case, so you can see that a cash deal makes sense when the synergies that you get from the deal are more than what the cash offer that you need to make is. Okay, this is a stock acquisition. Now this one is, you got to be careful about how the question is worded, because what this says here is what is the total number of shares in the new firm, whereas the last time I did this, it was how many new shares of stock will be issued. So you got to be careful to read the question. Read the sentence carefully to know if they're just asking you for the delta or if they're asking you for the everything put together afterwards. So if you have $20,000 that you're paying for the other company, and your current stock price is 20, that means you need to issue 1,000 shares, and so your company after the deal will have And last example for tonight, this is the net present value of a stock deal. So the net present value of the stock deal is the value of the target business, what it's worth to you, minus what the cost is. So it actually tells you the cost there in the question. What is the net present value of the acquisition given that the actual cost of the acquisition using company stock is $30,167? So you need to know what is the value of the target company plus what are the synergies to you, and well, that one is just given in the question. So the value of Q is 1,900 shares at 15. The synergy is 2,000, and your cost is $30,167 worth of your own stock, meaning that the net present value of that stock deal $333. All right, so that's it for tonight. I'll see you next week.